My name is Tim Clark. I'm CEO and Director of Fury Gold Mines. We're a Canadian junior exploration company focused on high-grade gold, and we've got a couple of resources and as well as some other small investments that we've been working on the last 3 or 4 years. We're excited because of the recent news with our PEA study coming out on our flagship Eau Claire resource in Quebec, as well as we've gotten Agnico Eagle to back our project up in the Arctic, and we've just finished drilling and moving that forward.
Good to see you, sir. How are you?
Good to see you again.
Yeah. Look, we're here at Beaver Creek. Obviously, the name of the game is meeting investors. How's that going?
We're chock-a-block. I mean, it's interesting. I think 2 years ago, it was a lot more of the actual bigger companies looking at smaller companies, corporate. Last year was more mid-cap. Now this year is more investors. It's interesting, right? And it kind of thematically works the way the cycles kind of go, and you can see things happening and coming. Yeah. It was like that when I was on the trading desk. Yeah. You could see people doing work 6 months, year in advance, and then you can feel the flow of the market coming, and it's here now.
Well, it's an interesting concept. It kind of sounds like a soft and fluffy thing to say, doesn't it? But I expect people at conferences to tell me it's awesome, but there is a genuine positive energy going on here because of what gold price is doing for everyone.
Look, I got into the Fury because I believed in gold was going to go, and it went in spades. And the hard part was, when was it going to catch into the junior market? And the game is on today, like now. Like, this is what we've been waiting for.
Right.
So if there's no excitement, then people are really missing the boat. But right now, these companies are catching a bid, and it's just getting started.
Yeah, no, it really is. Now, but the important thing is timing in all of this, right?
Risk and reward.
Risk and reward. Now, you just actually referenced the PEA. Maybe give some of the headline numbers there.
So one of the things we wanted to do with our flagship was we got to the point where we kind of cleaned it up over the last 3 or 4 years. We did a lot of drilling. We did a resource update. Mm-hmm. And I think investors want to see a pathway to production. Mm-hmm. And what the companies that have been getting the bid are the ones who are development moving to production. Mm-hmm. We're exploration moving to development. There's still a bid there, and you're actually getting closer to showing what this actually will look like. And so the black box kind of gets taken away when you show economics and the actual details in the mine, and people go, oh, okay, that's what it is. And that's when you get proof. So when you invest, you can never get proof and price at the same time, you know what I mean? You have to take a bet, and if you get the proof, the share price goes up. And so that's what I think we saw in the last week. Our share price is up like 30%.
Yeah, and you should take credit for that, because everyone else is taking credit for it. But look, back to maybe getting some numbers, and let's understand the scale of the opportunity we're talking about.
Sure. So we kind of look at these PEAs. The PEA is supposed to be what it could be, and the PFS is what it should be, and then what it will be with PFS. So this scenario, what's interesting is we are in a jurisdiction where there's a potential to do some toll milling, like shipping your ore to another mine. And there's a huge advantage in that because it reduces your CapEx numbers. And what investors have to remember, this is all financial modeling. And if you can defer CapEx spending, your net present goes up. So if you look at it like a standalone, assuming that we don't have any toll milling, I believe our assessment is we're 555 million net NPV with an IRR of 41%. And what goes in, whether the key kind of determinants of that are what you select as a gold price. Yeah. So we selected $2,400, which we thought was reasonably fair.
It was consensus.
It was, yep. And then what the difference, what's not in that people see is we used $1,900 for the mineral resource and $2,000 for the engineering. So that will increase your cutoff, which reduces your output. So from our point of view, we tried to stay in sort of the middle lane, not the fast lane in terms of how we compare, because it's trying to compare apples to apples out in the general market.
Yeah.
My point being is we're really excited because this was a lot more profitable at the IRR level than we thought. And if you do the toll milling, the IRR goes up to 84% if you're full toll milling, and that's a huge catalyst.
With the toll mill, because obviously the idea is to eventually build your own once you build up a kind of cash reserve, or at least can access cheaper money as a result of generating ounces. Toll milling for how long?
Well, if you do the hybrid for 2 years,
Okay.
our IRR is like 54%, and
Right.
that means you toll mill them until you get it built, and you defer capex for a couple of years, but you still build your mill.
Yeah.
And if you are able to put an agreement in for the life of mine, then and you don't have to build a mill, your costs get cut in half, your net present value goes up, your IRR goes up. But again, we wanted to do the 3 scenarios because we don't have an agreement yet.
Yeah.
But the idea is what it could be if we did. And the group that owns the Eleanor mine now are new owners, and they're doing a lot of drilling on their own. We've agreed to meet at some point, but we don't have an agreement. But you try to create scenarios when you do a business. You try and create scenarios where there's alignment, and in my view, there might be. So we wanted to put that in there.
Okay.
But as a standalone, what investors should realize is this is going to be profitable for what it is, and this is a reasonably acceptable kind of target to get to, that we can actually build this mine and get it going.
Right. And is there any kind of competitive tension in that? Because obviously there's what's nearby and then maybe others further afield, because you need that tension to kind of negotiate hard. So what are the other options available?
Well,
to you?
the other options are, because we've been advancing this resource, and it's a high grade resource, and there's quite a few. It's not. I think it's close to 2 million ounces, which is not on the big side.
Yeah.
But the question we have is, does it get bigger?
Yeah.
And right now we're not cut off. We're not cut off anywhere. So our belief is it gets bigger. And so companies that come in, and we're getting a lot of companies like corporations, other mining producers are coming in, and they're coming to site. So the question is, do we want to build it ourselves? Do we want to sell it?
Yeah.
Or do we want to, create a toll milling relationship where you get some nice profitability?
Yeah.
So there's a lot of opportunity for value creation, and what our job is to be a steward for this decision for investors, to try and find the pathway of the most upside.
Right.
And so that's what we're working through, and we're trying to continue to move that forward.
Okay, so so maybe I should frame the question better. So I was trying to work out, in terms of the tolling component, are there other groups that you could toll with, and just to preserve your margins?
Could be, but when you look at a map, it's
the obvious
pretty.
one. But it then becomes a case of, is it a kind of captive audience, or is it a case of, well, maybe you guys come together in other ways? I don't know the region well enough.
Right.
So that's
so
small.
we're 50, 60 kilometers from a very large mill that's being produced, and there's an opportunity there. It's not a primary focus. It's just what might happen. I think if it did, I think it would be reasonably positive for both parties.
Yeah.
But at the very minimum, we have a very good, profitable mine as a standalone case, and we can go forward with that. And we're getting enough attention from other producers that it shows that we're doing a good job, and this is going to happen.
Okay, you've done that. That's the usual response from investors is, great, now what? So how do you move through the phases, as it were, in terms of economic studies, or and how much of kind of expansion do you know? Is this enough for now to get going, get revenue flowing, or do you look to kind of build out the whether it be M&I category or what?
Well, if you're looking at, so as a junior, most juniors are kind of single asset mines. We happen to have a 300-kilometer greenstone belt up in Nunavut that's relatively unexplored.
Yeah.
So there's a lot of opportunity there with Agnico. And then in Quebec, we picked up another company called Quebec Precious Metals last January. It was a $40 million company 2 years ago. We bought it for $4 million. And we've been just finished drilling the Sakami property, and we think there's a potential to open up a resource there.
Right.
It also included a rare earth play that we're trying to figure out how to monetize south near Toronto. It's the only full feasibility study on a rare earth project that hasn't been built, so there's opportunity on those respects. And then on the M&A front, that's something we always are looking at.
Right.
And we probably reviewed a couple hundred already.
Yeah.
And the market, the problem with the market is, you know, now that people sense that something's coming, they don't want to let go of their properties. But what we see is we still see mismanaged properties and opportunities. And the other thing is size matters. So size matters for liquidity for investors. It gives you a premium. It also gets you into the indexes. And when you go in the indexes, you get typically a bump. And so a lot of these companies are chasing acquisitions to merge, to get bigger, to acquire more, to get into bigger indexes, and so forth.
Right. But coming back to you in terms of what you do to move yourself through the phases, there's a few things you talked about there. Obviously, you've got a PEA out and you say, well, the best use of our time, best return on our invested capital is to focus in on that. Or one or both of your other two projects.
So we're multitasking. We're doing it all.
But you got okay. The team's quite lean, and you know, and I get the big ideas. I get the big ideas, but you need time and you need money to execute.
So for example, we drilled Eleanor South this winter. We drilled Committee Bay this summer. We had another group in Sakami in Quebec. We're probably going to drill again in Quebec this fall, and then we're going to repeat the process next year.
Right.
My guess it's bigger and more to pull these projects and assets forward, and at the same time we'll look at new properties for sure.
Right.
The difference is my share price is a lot better than it was 6 months ago.
Yeah.
So now I'm not coming at these companies undervalued. I'm coming in more equal valued.
Yeah, you're kind of back to full strength again, right? Because it came off a bit, and that's why I'm asking the question here, because I want to know what the kind of inflection point is, what the upside is. You got rewarded 30% uplift after the PEA. You've done some work on each of the other two projects, drilling work, and you're going to repeat that. Were you rewarded for the work that you've done? And if you repeat that, will you get rewarded again?
So we're being valued like I think $25 an ounce, and our peers are around 50.
Right.
So do I think there's upside? 100%.
Right.
I think we're still undervalued for the quality of assets we have.
Right.
And the idea is what you want to focus on is your bread and butter, which is your high quality assets. And then you can go out and look secondary to other things and other opportunities.
Right.
But these assets clearly are worth a lot more than what we're being paid on a share price. So you look at our market cap. We're 165 million market cap. We have 65 million, I think, of Dolly Varden right now. That's our equity stake.
Yep.
Then we also have some cash, and so these assets are worth hundreds of millions, not tens of millions. Right.
Okay. So in terms of, you're saying to me, they're valuable in the portfolio, may not have been recognized yet.
It's getting more recognized.
Okay.
It's got more to go.
Yeah.
And the way you get it more recognized is you keep advancing those projects further by more drilling.
Right.
And you can also create more value for your company looking to acquire new assets of other things that you think are complementary and in alignment with your long-term strategy.
Right.
For example, if we found something in Quebec, boy, that's kind of our neighbor. Maybe we could have some synergies with workers or synergies in the spending on the company level. There's also other opportunities that we've poked into, we've looked into before. They just weren't ready yet, or their management teams weren't willing. Willingness is a huge part of this. If you go to, there's assets you might want, but you'll never get. And there's assets you don't want that they're happy to shove in and have you buy. And so part of the process of M&A is declining things too. So we are constantly, and this week we've looked at 3 or 4 that are really interesting. So we'll have to vet them out and go back and take a look, and we've got a great team to review the geology as well as the business opportunities, and we'll press forward.
Okay, so just I'm going to stick with it though. The market will reward you if they think you've got 1, access to capital, 2, can execute, and I guess 3, if they actually think the assets are capable of delivering what you say. You're saying they are capable of delivering. We have got the money to get after them?
So the cash has never been a problem for us.
Okay.
I would say we were probably one of the better companies at raising money during the bad times. And I've personally had a career in raising money for mining companies. Raising money is not my problem. I can raise as much as I think we need. I can raise more than we probably need. It's raising money at the right price is the trick. And that's what I also think we've been good at. So as an example, when I first came into Fury, there was a deal on the table for $8.5 million. They wanted us to do it at a 15% discount, 7% real broker fee, and a full warrant. But because I wasn't at zero, because I was sitting with $50 million a dolly, I said, you know what? I don't think I'll do that deal. Yeah. And we ended up striking it a couple weeks later for 7% discount, a lower fee on the broker fee, and no warrant. And that was probably one of the better executed. And so we've focused on the last 3 or 4 years, frankly, keeping our dilution low, 3 to 4%. So our share count has remained low, and therefore the upside for investors is better. The other thing we got rid of was warrants. We don't do, the only warrants we have are the agreement we did with Agnico. Yeah. And that's Agnico. It's a special story. They're long-term holders. They're at 6.5%, and if they go over their strike price, they'll go to 9.9 if they want to exercise those warrants. And I was happy with that because that money will go to Committee Bay, and it will increase their percentage of our company. And I think it's a good thing to have. But we don't like to give away upside. When you give away warrants, you give away upside. And it's not to the advantage of the shareholders, in my opinion.
Agreed. Flipping back to the M&A component, it's really in response to what you're saying. So, like, you want size matters, and you weren't talking about ounces coming out of the ground necessarily. You're talking about the company, the corporate setup, the structure there to get on the indices and ETFs and all of those wonderful things, which kind of really drive liquidity.
Right.
Is M&A the only way is the only thing that you're focused on in terms of creating that scale in the short term?
No, there's a couple ways to create value, right? Yeah. You make smart transactions, right? And you get a good deal. You promote or build the assets you have, or you make a new discovery. And we're constantly stepping out. So up in Nunavut, we put 4 holes next to 3 bays resource to build out the resource, but we stepped out 50 kilometers and put some drill holes in. That is total greenfields exploration. If you hit something, it can really change the whole market price of your company.
Right. I was thinking more towards corporately things like which exchanges you trade on.
So we're already on the New York Stock Exchange,
right?
And that's a huge advantage for Fury. 2/3 of our shareholders are U.S. retail,
right,
including our number 1 shareholder, which is a major U.S. Mutual fund company. I've fought hard to keep it. It's expensive. Sure. Most juniors can't afford it. Yeah. We had the dolly money, so we could afford it. And for example, in our PEA, when that was released last week, we had 1,000,001 shares traded in Canada. We had 4.4 million traded in the U.S. So for me, that's already checked. Yeah. And so for me, my focus is really on what we've discussed already, which is taking my assets, getting the most money. And mind you, the better recognized I get, the more share price I get, the more active and aggressive I can get with the M&A doing smart deals.
The reason I ask, I think was it Newmont today talked about, I think it jumped off the TSX and just basically moving to the US.
Yeah, they cut out the TSX and listen, we're a Canadian company, Canadian domiciled,
Yeah.
but make no mistake, all the incremental money is in the U.S. There's some in Europe, and there's other places around the world, but the amount of dollars that could flow into these companies is really domiciled on the U.S. exchange. Even a lot of Europeans, and I talked to a guy from Japan, they all trade on the New York Stock Exchange. So I get that, and it reduces a lot of their accounting costs. It's not a dumb thing to do. I don't mind being on both exchanges because we have a lot of history with Canadians and a lot of Canadian investors, and we want to be consistent, and I think it's smart for us to do it. But again, if you're looking to get into the junior exploration companies, being listed on the New York Stock Exchange is a deal breaker for a lot of retail people and retail brokers. So I've gone out to retail broker events where these guys run millions of dollars, and they're like, if you weren't listed on the New York Stock Exchange, I can't buy you, right? And so I went into a retail broker in New York recently, and I had like an hour meeting, and he kicked me out in about 10 minutes. And I was like, what happened? And he goes, look, let me get this straight. He goes, I have to run all these other stocks, but I want to make sure I have a couple in my pocket from the junior exploration stuff. And he goes, let me get this. You used to work on Wall Street. You know some of my friends. You got your big accounts out of Boston and New York that are on the institutional side that I know. You got Newmont, you got Agnico, and you got a couple other things, and you're listed on the New York Stock Exchange. He goes, get out. That's all I need to know. And he's in. And that's a big check. Not to mention, we have the Dolly Varden, and we're not going bust. We're not going out of business. We're not losing money. I don't think people are worrying about that right now. Truth be told is a lot of people are going to be out there raising money, and what investors should be focused on is, are they just grabbing money for the sake of grabbing money, or are they going to be smart with that money? And what we're going to do is we're going to accelerate what we've already been doing in a bigger way, and I think it's the right time to lean into it, because this is the time you're going to accelerate your share price, grow your company, and return some real value. And this is what I've been waiting for a decade. Literally.
Good, man. Appreciate that. Look, obviously you're doing stuff on the ground operationally as well, expanding there. But I think the market view, and I can back that up. I was speaking to a fund manager yesterday who said pretty much the same thing. So, stay in touch. Let us know how you get on.
It's time to hit it. You know, it's game time.